One important announcement for those of you who are either tweeting or tracking tweets, we do have an official hashtag for the OVA Summit. It is OVA VC Summit. So again, if you are either tweeting today or tracking, look for OVA VC Summit. All right, we've been talking about cultivating the ecosystem, and now I want to move on to our second panel, which is about capital. So deep feeding those roots that we've been cultivating. Mr. Barbaro, I'll let you. Quick change of speaker. And I'm now going to introduce our moderator, Paul Allen, who's the president of Bizdom Cleveland. Paul is a creative tech strategist, catalyst designer, writer, and sales and marketing executive with over 20 years of experience in new product development, enterprise and consumer software, education tech, health tech, payments, games, and nonprofit sectors. He consults with a wide range of startups and established businesses. In a prior life, which I don't know how he fits it in with all those other things he's doing, but in a prior life, Paul was the executive director of the Connecticut Software Association and vice president of the Connecticut Technology Council, where he received the Governor's Award for achievements in mobilizing seed stage capital. He's also the founder and managing director of Tribe of Angels, an internationally recognized network of over 8,000 angel investors, university and industry researchers, journalists, executives, and entrepreneurs spanning 25 countries. Now, joining Paul on the panel today, we have Morris Wheeler, the founder of Drummond Road Capital, Dennis Cocco, the co-director at Glide, which, for those of you who aren't aware, is the Great Lakes Innovation and Development Enterprise, Jake Crocker, the founding partner of e-CapFunds, and Howard Barbaro, partner in the Business and Finance Group and a member of the firm's executive committee at Taft Law. So please join me in welcoming our moderator and our panel.
That's quite an intro. Thanks, Jim. It's a thrill to be here again. I didn't think I'd be invited after last year's moderation episode, so some bad judgment, I think. Everybody hear me okay? Here we go. So welcome, Cleveland. How you all doing today? Good. Try and keep it down. Who here has a Twitter account? Raise your hand if you have a Twitter account. All right. So again, I'm with Bizdom. Bizdom is a startup accelerator that was started by Dan Gilbert, who's the chairman and founder of Quicken Loans. He's also the owner of the Cavaliers and the Lake Erie Monsters. So just to make this fun, accredited investors that have a Twitter account, raise your hands again. 2 people. No, just kidding. If you tweet, direct tweet me, is that right, Morris? Yeah? Direct tweet me to Bizdom Cleveland, something, I don't know, what should we do? Kendall, what color shirt are you wearing? Blue shirt. Right, tweet the word blue shirt to Bizdom Cleveland, and we'll get you into a suite for the next Monsters game. All right? Yeah, that's actually 2. Huh? Bizdom Cleveland. Whatever, all right. So we're going to get started here. For those of you that don't know, Bizdom is in the business of starting up startups. We're just a couple blocks from Charles, so we're going to be partners this year, along with Launch House. And you know, the exciting thing is I'm not from here. I'm from California, but I've been in Cleveland about 7 years. When I first moved here, we didn't really have any formal support for pre-seed technology companies. You know, there were no programs offering capital or structured assistance. Certainly we had Jumpstart, which is a big deal for the region, but slightly later stage, certainly at the time that I moved here. This year in Greater Cleveland, we'll launch all these 3 accelerators, plus Magnet, you know, well over 40. So we're going from a year ago, 0 approximately with structured support, to well over 40. Obviously, we're going to have a lot of challenges, not only in helping these businesses, not only in recruiting these founders, but helping these businesses to grow faster, farther, and finding the financing for them. So that's primarily what we're here with this panel to discuss. And I'm gonna ask some questions, and I'd like this, you know, if we can, to get into some of the more difficult, maybe tricky issues that we're going to face as a region, launching all these new tech companies and trying to get them financed. So The year's 2004, and a kid named Mark Zuckerberg, he's attending Case Western, and he has this idea for a social network to connect students. He's not making any revenue, he's just connecting a few students, and he asks around, you know, he wants to buy his own server, and you know, he can't afford it, so he asks around, and he's told to go to Glide, and get some funding from Glide. He doesn't have a pro forma, so you know, he shows up at your doorstep, Dennis. What happens?
First of all, in 2004, I had less gray hair, so it's a little easier. You know, Glide is Glide is an incubator. It is an incubator. We're fortunate to be funded. We've been funded since 2006. We've been in business for 10 years. But in our case, we would really spend some time trying to understand what he's trying to create, what he's trying to do, how he's going to do it. We generally, before we even think about funding and supporting a company like this, our job is to try to understand the business model. In case of Mark Zuckerberg, I wouldn't understand it. I mean, that is the challenge that we all have. And I know Charlie works with a lot of IT businesses. The biggest problem that we have, especially in the social media space, is what is the product, what's the customer, and how are you going to make money at it? And maybe in the case of Facebook, they may never make money at it. I don't know. It's much easier in some of the other places that we deal with, and that's what all of our challenges are, is understanding the real changes in the world. I was talking to somebody last night about their business. One of the things that we do, not to get on it for a long space here, but one of the things we do in our fund is we debrief everybody who does not get funded. And I tell everybody that's the hardest job I have, is to try to explain to somebody why they didn't get funded from us, what do they need to do differently, what maybe pivot they need to make. And we mentioned the fact that I have to make sure that I don't have my own prejudices, my own thoughts about where the market and world's going. The people that really amaze me the most are the people that have that foresight to think this is what the world is really going to need and want going forward. And that's what we all have to think. We have to think a little broader and a little perspective. And so in my case of Mark, I'd have to be very honest and open. I don't know what the business opportunity is, but let's find out. Let's try to get you that first $25,000 to see if there is a business here, and that's where we are. Our job is to take that really high-risk business and try to get them to that first early stage to see if there is a business.
Okay, great. Anybody else want to comment on that? No? Okay, so it's wonderful that we have in this region all this support. We have county support, we have state support at the earliest stages to get these businesses started. Yet there can be some drawbacks to accepting state or county funding. I mean, one obvious one is just the length of time that it takes, right? The process to go through to obtain the funding is time not spent on the business. Morris, you travel around the country, you visit a lot of accelerators, you're familiar with how other ecosystems, other regions operate and get these businesses financed. What's been your experience?
Well, let's start with a definition. In my world, and as I often tell the companies I work with, this is just one guy's opinion. In my world, a startup by definition is an entity that is searching for a product and a business model. A company already has found it. A startup is searching for it. So in my world, I've come to the conclusion that we are doing entrepreneurs a huge disservice by making them think that their first order of business is raising capital. Their first order of business is show me. You know, no, I don't understand your business model. Build me a prototype. Show me what it looks like. Show me that there are customers coming. You shouldn't need any money to do that. If you do, then you don't have the creativity and innovative problem-solving ability to be a startup entrepreneur.
Right. So in our experience at Bizdom, 9 out of 10 times the founders, and this is an issue we need to address, don't have the technical abilities, the technical skills, right? So they have to go out and convince, or more often than not, they don't have the finances to pay a developer, and they can't convince a developer to do it, you know, for equity. And so they're kind of stuck, right, without any check writing angels. Are those check writing angels more prevalent in places like Boulder and in San Francisco, or are we at a disadvantage in that regard?
Well, and again, I think arguably there may be more total dollars, but I think the main difference is in the appetite for risk and the understanding that the opposite of success is not success, it's not failure. So I think a lot of times what happens here is if an entrepreneur tries something and isn't successful, they get branded a failure. And in many other communities, a lot of the communities that I've worked in before, they just get branded not a success, keep trying, keep coming back.
Right.
And that's a huge difference. And that's in part, it's a function of the ability to risk capital. In a lot of these other communities, there are entrepreneurs who have built a business already, made money, and they have a different approach to their capital because they look at it as, you know, I worked hard, I made this money, if I lose it, I'll make more tomorrow. Whereas in other communities, such as ours, it's a lot easier to get someone to donate to the arts or to donate to the Cleveland Orchestra than it is to get them to back an entrepreneur where they might actually see their money back. And I mean, I don't think that's a bad thing. I just think it's something that we need to recognize in the difference in motivations in the way that potential angels think and work in our region.
Okay.
Can I add something to that? Something more said about tolerance for risk. I don't think we necessarily have less. Let me say it differently. I think maybe in the aggregate we have less angel dollars here in this region than maybe in some of the traditional tech hubs. But I think maybe a good argument could be made that on a per capita basis, maybe we have more angel investors and more people that are doing this in this region than we do in some of the more traditional tech hubs. I think the issue is more about tolerance for risk and tech investing in general. People invest in things that they know. And if there were some really big tech exits in this region, I think more investment dollars would flow into those types of deals. When you get that in Minneapolis and in the Research Triangle and in Silicon Valley, you know, if somebody has an exit in a tech deal or a software deal, all of a sudden they're an expert and they're going to start investing in a lot more deals like that. And I think one of the things we need here in this region to help cultivate the emerging growth company economy, especially in the tech sector, is some exits. I think exits will create a situation where there will be follow-on dollars. It's like a follow-the-leader mentality, I think, a lot in the angel community.
That's great. Just building on that point, so obviously there's a dynamic and relationship between the quality of the deal flow, the appetite for risk, and then successful exits following. We certainly have a challenge, whether we're making an effort, and we certainly are, and I know the other accelerators are as well, making an effort to drive more quality deal flow out of our universities, which have, to date, produced limited quality deal flow. So Jake, in your experience, you've had some interesting experience with Bad Girl Ventures and ECDI, sort of at the pre-seed, very early stage, identifying promising entrepreneurs. You had a couple, I think, interesting exits. What's been your experience in that regard in finding the quality founders and putting together quality deals so that we can have some of these exits?
Yeah, from our experience, it's all about finding the right individual first as opposed to finding the right business. I think, the business and the idea is very important, but you got to work with the character and the individual first. That's what's going to create, an amazing company at the end of the day. And so, our experience primarily has been we can get farther faster with collaboration in, a lot of the different organizations around the community. And so, for example, a foundation that I represent, the Business of Good, our goal is leverage and leveraging dollars, not in the traditional sense of private equity, but saying, if we go out and spend $200,000 on an idea and bringing micro enterprise to Cleveland, that's going to be fine and dandy. But wouldn't it be better to go out and spend that initial seed money in getting others involved at the front end? Regardless of who gets the credit at the end, and then come up with a loan portfolio that's in excess of $4 million at the end of the process. And so that's kind of how we got involved with Bad Girl Ventures and ECDI, and then Huntington Bank and the Cleveland Foundation, and a lot of other large organizations in Cleveland. And now we do have a $4 million loan portfolio that's out making loans to deserving entrepreneurs in this specific area. And so for us, we think of leverage, and that's a 20 times return on our investment, and that was a worthwhile project.
Mm-hmm. Great, great. What role does collaboration play in feeding the roots with funding? We certainly have in the network that Jumpstart has started and is nurturing lots of organizations regionally coming together and discussing deal flow, and that's critical. But sort of at the front end where there's interactions with angel investors and founders earlier on, whether it's part of the screening process or it's the earliest stages of building revenue or finishing a product, we've got these various initiatives, which is great, and they're talking to one another. But we have, in a sense, a shared body of mentors and investors that sort of shuttle between the different organizations. I'd just be interested in your comments on, are there ways that we can make that collaboration more efficient, particularly at sort of the ground roots level where the founders are operating, they're looking for advice, they're looking for connections, they're looking for capital, where they can get the access to North Coast Angels, that list of angels. They can have the conversations. I can tell you, I was in Boulder just a couple months ago, and I reached out to Brad Feld, and I said, I'm going to be in town for 2 days, and he set me up with a half dozen meetings, and everybody said, if Brad has time for you, I have time for you. And I'm not sure that we have yet, I think it's getting there, but I'm not sure we have that mentality here in Northeast Ohio yet. There's fiefdoms, there's cliques, there's old families that go back. Can we tackle this?
I think so. I think it starts, from the investor base and in the area, and we're talking about, the investors don't have a long history with investing in startups and technology like they do in different, parts of the country and on the coast. And so if I think, let's just use the baby boomers for an example, as they age and they have a capital base, and instead of putting it in traditional marketable securities, let's say, and closing your eyes and looking at the paper, once a month to check how, your stock portfolio is doing, it's a lot more rewarding to be actively involved in building a business, as we talked about earlier. And I think as long as people, and it's coming, as people understand the risk-return trade-off, I think it could be certainly financially more beneficial as well. But in my experience, that's coming of age now. In much more, it's much more the current baby boomer set, will take a little bit more risk, I think, with their capital than the generation before. And certainly, the Generation X, those who have exited businesses, virtually all of their capital are put back into entrepreneurs and other startups, because that's what they know and that's how they made their money previously. And it's fun. Mm-hmm. It's a lot of fun.
Yeah, great point. Morris, how can we do a better job here?
Well, I think, going back to the Boulder model, in Boulder, they've come up with some, fairly repeatable processes for helping to foster a startup community. Brad's book that Charles is fond of giving to people, as am I, outlines some pretty specific steps and some pretty specific guidelines, starting with, this is about the entrepreneurs. There's not going to be one single leader. It's not going to be one single group. It's going to be all of the entrepreneurs who can bring people together for whatever reason to talk about things. It's entrepreneurs who have experience in tech and those who don't. Because if you've run a business and you've started a business, you have valuable information to impart to somebody who doesn't, even if it's a business that you don't understand right now.
Right.
It has to be completely inclusive. There can't be these cliques. There can't be this lack of transparency. People need to be comfortable talking to each other and sharing with each other what they're doing. There has to be a well-known and set out rules of the game.
Right.
You can't have people saying they're mentors and going out there and preying on entrepreneurs trying to get services contracts or something. That just doesn't work.
Right.
And Jumpstart has done a great job starting to put together a mentorship program which creates the rules of the game. We need to open source that mentorship program and tell everybody what the rules of the game are, and let every mentor, whether they're a Jumpstart mentor working with companies funded by Jumpstart or otherwise, use those same rules of the game and create a community of mentors that both understand the rules and understand how to help the entrepreneurs that they're working with.
Right, right, great point. Well, and Dennis, just to build on that, do you have a comment on that specifically?
Yeah, I do.
Okay.
I think he's spot on. And I think if you look back, I'm not that old in this space, but if you go back 5 years, there was nothing. I mean, we just started the Angels, North Coast Angels, and I think it's been a catalyst for a lot of thinking in that space. But one of the challenges that I've seen is that entrepreneurs don't understand when it's the right time, or know, more importantly, how to position the business. And so one of the things that we emphasize, and at the very earliest stage of their business conception, let's think about your pitch, how you're going to position your business, what it really is or what it could be, or make sure, because one of the worst things they do is we see is that, and you can turn off these angels by people coming in with half-thought ideas or half-baked ideas or half-thought through. But unfortunately, most of the people that are going to be angels are fairly sophisticated, experienced people who have a fairly clear idea on where to go. And what we have to continue to focus on, and that's one of our jobs. I mean, we give a little money, but one of the things that we work with the rest of the collaborators in this room is we've got to continue to teach entrepreneurs, particularly those who have never done it before, how best to position their business and think through their business before they go out and start trying to sell it for capital. That too many of them go out too early and start trying to raise capital before they even have an idea of what their business is going to be.
Right. No, it's a very, very good point. So just to go back to Boulder, while I was there, I met with two entrepreneurs who host weekly coffee gatherings where a lot of this vetting and a lot of this refinement of the ideas occurs. And Morris, on your point, it really is this open model. There's complete transparency. Everybody knows who the check writers are and the posers are. And everybody knows who to go to work on things like a pro forma or work on things like the technology. So do we have anything like that that's equivalent? I'm thinking of maybe Launch House. We're trying to do some of that stuff. I'm sure others are. We have workshops that occur, but they just don't seem as spontaneous or as continuous as they are certainly in Boulder. Any thoughts on that? Is there a way to open this all up and maybe have it be a little bit less proprietary?
I would say getting all of the different providers of capital up and down the spectrum, from the micro enterprise providers to the Jumpstarts of the world, even the incubators of the world, and Magnet going into the next stage, which is the post funding, and then into the last private equity. Having some type of a group that meets monthly I think would be pretty valuable in terms of sharing ideas and helping each other and taking companies from one stage to the next.
Right. I mean, Howard, in some regard, I think it's attorneys or it's CPAs often that play sort of a catalyst role in this region, more so than what we might call finders or deal makers in the Bay Area. And that may be a strength, that may be a weakness. Any thoughts on that?
I actually want to go back to.
Yep.
Hold on.
Yep.
I mean, it could be we're describing the Ohio Venture Association. I don't want to put in a plug for the organization, but I will. There are monthly meetings. They can serve as these sort of open forums. There's networking. It's a place where entrepreneurs are encouraged and intended to gather and talk and exchange ideas. I think there are these other sort of spontaneous forums around too. I can't think of any right now, but I'm pretty sure.
OVA is one great forum,
right.
But there needs to be many, many more. There needs to be groups of entrepreneurs who just get together for coffee. There needs to be a group of angels who get together for educational opportunities and to talk about how do you do this, and to talk about, you know, I've been running a specialty chemical company. How can I possibly help a technology company? OVA is a great organization, and it's one piece of the puzzle, but there needs to be 15 others.
Right, right. All right, so we'll open this up to questions in a minute. Hopefully we've got some provocative. Has anybody tweeted? Raise your hand if you've done a tweet. Oh, that's heartening. That's wonderful. It's going to be a small suite, so please get on it. It's like 6 people. So, you know, let's loosen up our ties, have a few beers, and get together with in some of these coffee house forums here, and maybe do a couple of those a month. Who would be up for that?
Oh, yeah.
All right, that's a few. So, all right, so Mark Zuckerberg goes to you, Dennis, and you plug him into some smart folks in the region to get some input, and then he comes back to you maybe for the next pitch, or those folks have gotten back to you and given you some input. It can take a while, right? The process can feel lengthy. I think, in fact, it probably is lengthier than it might be in other places. I think that's fair. What are the costs of that time lag, the amount of time that it takes us to get some of the more promising ventures backed?
Wow. You know, as I've been doing this for a while, one of my fears is we do take too long. I mean, if you look at, just take a look at what we have to do for funding $300,000 in a quarter. You know, it takes 6 to 12 weeks just to vet the ideas and then fund them. And then after they've done that, they got to go out and design a project, complete the project, report on the project, and then maybe they'll go to Jumpstart. And what worries me is that we all failed. We put people in this process, and and Jumpstart could be another 3 to 6 months, and maybe Angels will be another 3 to 6 months, and we're spending years trying to raise capital for business ideas and not really getting them move forward fast enough, even though, you know, we're putting them under some discipline. I really believe that, you know, the idea of accelerators and quickly finding out where there's market opportunities is so important, and getting people out into the market to find out whether they have something. I think we've got to change. We've got to start thinking about ways to accelerate what we do and work more collaboratively together, more in parallel rather than in sequence. And I think that is one of the challenges we have. And, you know, I work with John Dearborn and Jumpstart, and we try to manage all this deal flow and try to make sure that we sequence it through the process. But in the reality is, there are times when we shouldn't be doing that. We need to move these people very quickly into the marketplace to validate their opportunity, and we don't do that enough. I really do.
I'm going to disagree with you. I'm going to disagree with you for this reason. You know, Glide, Jumpstart, a venture fund, you've got constituents that you've got fiduciary obligations to.
Oh, I agree.
And in order to do the due diligence and to do the work that's necessary to meet those fiduciary obligations takes time. Any entrepreneur worth being funded understands that and should be socializing their venture to you while out talking to the angels, where I can make a decision in 3 days. You know, I'm not going to invest in an idea. I'm going to invest in a person, and I want them to not tell me what they were going to do. I want them to show me what they're going to do. And the bottom line is as an entrepreneur, you need to get together with other entrepreneurs. You need to talk about how do these things get done. You need to talk about, I always use the example, if there were a nuclear holocaust today, one of the few things that would survive would be cockroaches. And I always tell the entrepreneurs that I work with, be a cockroach, not a victim. Don't sit here and tell me that the process takes too long. Don't sit here and tell me that there's not enough capital out there. Be a cockroach. Figure out how to make it work. Figure out how you're going to survive. Show us what's going on. Don't need the funding, and it'll find you.
Right. Okay, fair enough, Morris. But so there's this gap. We have folks coming out of accelerators. They've got $20,000, $25,000, whatever. And, you know, they may or may not, at the end of a 2-3 month period, have solid market validation. In fact, the majority of them are going to need more runway. Mm-hmm. What do they do? Because it's going to take a good 3 to 6 months, if they're successful, going through the glide and the jumpstart path. Maybe it can be accelerated a bit. I think we've seen that. And a lot of those businesses obviously aren't going to go anywhere. But we just simply don't have, and we're talking about 40 businesses this year. I think that the collaborative, coffees, that would help a lot. I think if we had something that was more open, I think there's some of that going on. I think a lot of it's siloed, but there's a speed to market issue in some cases, and I see it. I see it with our businesses.
One of the gaps we still have here is that in-between money. You've got friends and family money to start. To a certain extent, you've got angel money. But in other cities, what you see with the angel money is often led by one or two lead investors who are doing a lead investment. They're essentially somewhere between an angel and a VC. They call them either micro VCs or super angels or whatever you want to call it. We don't really have that here yet.
Who comes closest?
In the Cleveland area?
Yeah.
I don't know that there's, the North Coast Angel Fund, I suppose, is the closest, but they're a fund. They're a fund with fiduciary obligations that has to have a process.
Right.
You need some sort of a super angel or micro VC where their process is a 2-week process, a process which solves for yes instead of solving for no. A process which says, I can see how this is going to be big. I can see this entrepreneur being someone who can build a team and do what it takes. I can see that there's a technical lead and a non-technical lead. 2 weeks, we're in.
Right, and obviously that's correlated with higher quality deal flow. But all right, we must have some questions. Who's got a question? Yep, Charles.
More of a comment. Why don't we take what we know that startups apply to the process? Instead of a minimum viable product, let's define a minimum viable process, and then go back and work on the speed of iteration.
Yeah, listen, we're new at this. Everybody's new at this, and we've learned a lot. I tell people all the time that people we funded 5 years ago, we would never fund today. It happens, and so we've got a better sense. We put people through more rigor. We do ask them to do some financial forecasting, so we have some better sense of what their opportunity is. And we're constantly changing, but we got to look. We do need to think about other ways we can do this. And so, one of the things I don't want to become is complacent. We've come from where we were 5-10 years ago to a much better place, and I think we need to continue to talk and collaborate with each other, using ideas that Morris and others have to figure out ways to continue to get better. If we don't, and we just sit on what we've been doing, we're going to just sort of churn. And I think we're never going to be the West Coast. Maybe we will. Maybe we'll be that. I don't know. But what I do know is that we can do things a lot better, and we need to talk and collaborate much more than we're doing.
Howard, you have a comment?
I was thinking somebody needs to talk about, and I guess I'll start it. This is probably a good time to talk about the Jobs Act and crowdfunding, because I think that there are changes coming in how companies raise money that could be transformative to the way this capital gap is bridged. It could also be a whole lot of nothing for a lot of reasons that we can talk about. But the Jobs Act was passed in April 2012. When it was passed, President Obama said something to the effect of, now for the first time, Americans are going to be able to invest via the internet in entrepreneurs that they believe in. And that's not all necessarily true, because you can do that today. You can invest in any entrepreneur. Well, let me change what I just said. You can give money to any entrepreneur that you want. There are several websites that are doing it: Kickstarter, Indiegogo, Rocket Hub, I think, is another one. There was a film at the Oscars, the first Kickstarter-funded film won an Oscar for, I think, Best Documentary Short. It was called Innocente. These things are going to be becoming part of our daily lexicon very soon. So this could be a huge transformative event if companies are able to essentially go out and raise money via the internet through what we would formerly have called general solicitations.
I'm chomping at the bit here to give an alternative view, because I think equity crowdfunding, which is way different than debt crowdfunding, that equity crowdfunding is downright dangerous for entrepreneurs and angels. It doesn't mean it can't work, but I'm a guy that goes around and tells entrepreneurs all the time, the last thing you want to do is a country club raise. In a country club raise, you're dealing with people who aren't used to investing. You're dealing with people who are what I call a one-check Willie. They don't understand that the $50,000 they put in the first round is the first money they're putting in, not the last money they're putting in. They don't reserve 3 times what they've invested in the beginning to invest later. And you're only going to, and you create a cap chart with 37 individual investors that you need to deal with, that you need to get signatures from, that you need to get their input and communicate with in order to keep your company going. Crowdfunding on the internet is only going to exacerbate that situation.
So I agree. I actually was, when I was sitting here earlier, I started to make a little list of disadvantages of crowdfunding. One of them is, if you want to raise $500,000, there's a limit. Crowdfunding, the new Crowdfunding Act creates limits on how much each investor can invest, and I think it's the greater of $2,000. I have it here. The greater of $2,000 or 5% of annual income or net worth if the net worth of the investor is less than $100,000 or annual income is less than $100,000, or 10% of annual income or net worth up to a maximum of $100,000 if the annual income or net worth of the investor is greater than $100,000. So let's say you have investors that have net incomes of $100,000 and you want to raise $500,000. That's 50 investors. Did I do the math right? 100 investors. 100 investors. That's 100 investors on your cap table that you have to communicate with. You have to provide. Answer questions. They're going to. I mean, and these are not institutional professional investors. These are guys. I mean, it's maybe not even the caliber of the country club investor. These are guys who are writing a check for $5,000 or $10,000. They're going to be calling you every day. How's my investment doing? You know, what's going on? Did you get to market yet?
Rate of return.
And that's going to that will take up a tremendous amount of the entrepreneur's time that needs to be focused on executing their business plan. You know, another thing about there's other disadvantages of the Crowdfunding Act is nothing's confidential. You know, when you do a traditional private placement, go out and raise money, it's a confidential private placement memorandum. When the Crowdfunding Act goes into effect, which it hasn't yet and it was supposed to, these things are going to be online. Everything's going to be online. Your financial statements, your tax returns, everything about the company that used to be confidential is basically available to the public. So that's something that a lot of people haven't thought about. The limits, you can't raise more than $1 million in any 12-month period. The limits on individual investors, you know, to invest $5,000 or $10,000, if you have a 5x return on your $5,000 investment, you've made $25,000. Does that sound great to me and probably a lot of people in this room? Yeah, but in terms of institutional investing and IRR and transformative investments, I don't know if that moves the needle.
What does it do to the return on your capital when you got to spend $30,000 to $50,000 to have lawyers prepare a PPM to protect the management team?
Right. Right.
All right, good stuff. So any questions here?
No,
yeah, Kendall?
offense.
I think everyone's going to hire the lawyers.
Can't hear you. Yeah.
How do we find the Rays?
Ray who?
Ray from Stereo.
Oh, hey, Ray.
That right.
You know, he basically, his story,
Yep.
you know, is like the analog to the Zuck story.
Sure.
So how do we find that? How do we, you know, help him? I just think that there's an overselling of become an entrepreneur, and you're almost soliciting it.
Uh-huh.
Where I think it's an internal person that has an idea, even though it goes through the challenges to get his idea out, is able to grow it. Like, where are those people, and how do we kind of proactively find those people?
Right, right. So it's a deal flow question, and you know, how do we find quality deal flow? And again, I mentioned, you know, we have significant efforts going into all the universities at this point, and we've attracted founders from San Francisco, Seattle, Los Angeles, New York to move to Cleveland to launch their tech businesses in the past year. So, and we need to continue that because we don't see the deal flow here. We see some of it, but we don't see the caliber that we need. So. Yep.
But Kendall, it's a matter of what we're teaching our kids and the expectations that we're giving our kids. In Cleveland, Ohio, and most of the United States, kids go through high school and they think that the only path to success is to go to college, to get a good job, to go work at that accounting firm or that law firm, and to get a graduate degree. Whereas in San Francisco, these kids aspire to being in a startup and starting a startup. And we need to teach our kids that either of those paths is acceptable. Either of those paths is possible if you have the right qualities. And obviously, we need to help them figure out, you know, which one of you is an entrepreneur and which one of you is a doctor and which one of you is a lawyer. But we need to let them know that all three of them are options.
And just on that note, I want to mention, on the way driving over here, I got an email from Natasha Chorneski. Anybody know who she is? Yeah, so she just moved here from Las Vegas by way of LA, and she is the director of entrepreneurship at the Hawkins School. And she's not just interested in teaching entrepreneurship to rich kids in the suburbs, but she's also looking at ways to do something transformative in other parts in the core of the community. And Steve Blank just featured her and her story on his website yesterday, her introduction of the lean startup approach at the Hawkins School. She went out with a colleague to the Bay Area to learn how to do that from him. So I think that feeds into that, and it's exciting. Yep. That's great.
Just to go back to the topic, deep feeding the roots, and to follow on what Morris said about teaching our children, mentioned already, it's more of a rhetorical question. What can each of us do to encourage our children to engage with people? I know from my own experience, getting my children to pick up the phone and actually talk to someone, not text them, not tweet them, is next to impossible. And I am very concerned, deep feeding the roots, that these connections, which are so essential, as Morris, you've talked about, we've got to do things to encourage them.
Well, but this is a pet issue of mine, okay? You need to understand that when we were teenagers, or maybe when I was a teenager, you're a little younger than me, we sat on the phone all night long. We called party lines. That's how we communicated with our friends. Well, my 14-year-old and my 16-year-old, they communicate through text, they communicate through Facebook, they communicate through Skype. It's not that they're not interacting with their peers, they're just interacting differently than what we did. What we need to teach them is the hierarchy of communication medium. You know, if you need to know if someone's meeting you in 15 minutes and they're not someone that responds to a text, you need to understand that you got to pick up the phone and call them. You know, and I have an assistant who's in her 20s. I constantly have to remind her what the hierarchy of communications is. But it's not a matter of telling kids don't text, don't use Facebook, you know, get up out of your chair and make a phone call. It's a matter of us just making sure that they are interacting and that they are having those conversations.
And you could probably still do that via sports and other organizations. I mean, I think that's ultimately where we all learn that is youth is, you know, being part of a team and communicating and collaborating, and that's even my young kids. That's still, I see that to this day.
Sure. No, absolutely. Absolutely. Yep. Jay.
You know, I hear a lot of the lessons of entrepreneurship, market validation, prove it with sales. I'm wondering if the Y Combinator pivot that Paul Graham has done in the last 8 months, where it's founder, founder, founder. I'm just investing in a person. The ideas will circulate and figure it out. Is that doing a disservice to the rest of the landscape?
Can you clarify what you mean by disservice?
Well, if we're all about market validation and we're trying to prove concepts, find the pain, drive towards the most elegant solution,
I got you. So is the focus on market validation as a service? Yeah.
Right. They're not inconsistent.
No.
The bottom line is, you know, it's exactly what we were talking about before. You find the right jockey, and they'll figure out which horse to ride and which horse has got market validation. Now, Y Combinator is a whole different cup of tea than anything that we're talking about here. I mean, they're running 100 companies through there a year. It's a little bit gone a little bit too far, but they're, you know, you have to focus on the founder, because if you're dealing with startups, by definition, there's no company yet. And the idea is finding those people who are going to be most likely to get from startup to company, and being able to guide them through a process to help them figure out what idea is going to get market validation, and then how to get it with the most capital efficiency in the shortest period of time.
How are we doing on time? I think we'll keep going. Okay. Any questions? Yep.
Just kind of coming at it from a number of angles, but I teach at Kent State, and one of the challenges in the entrepreneurship program, one of the challenges we have is kind of this quick fix orientation that students have, and it really starts with, you have a great idea,
Right. Well, briefly, I want to say we want those students to come to Bizdom or Launch House or Charles Accelerator or to Bagot. And I know for our part, you know, we spend probably the first week disabusing these founders of a lot of the myths of being an entrepreneur.
Launchpad, you know, which is a great concept, you know, Launchpads at 3 campuses.
Sure, yeah.
It still feeds that myth that it's nice.
Be your own boss, you make your own luck, yeah.
You know, if I could just add to that, you know, one of the concepts with the Innovation Fund is that every entrepreneur has to hire a student for an internship, because what we're trying to do is give students real-world entrepreneurial experience working with an entrepreneur. And so we've since we started, we've got about 150 students run through the program. A number of those students come back saying, this is not for me. This is really not what I thought entrepreneurship was really like, or what starting a business was like. It's hard work, it's long days, it's, you know, a lot of cold pizza. And a lot of other ones said, boy, I love this concept. I want to do this my own. I think one of the things we can do, at least in the university setting, we need to get more entrepreneurs exposed, more of the students exposed to entrepreneurs working with them. And one of the things that we've also found that our entrepreneurs appreciate students because they're usually energetic, they're exciting, they can't wait to come to work, and they're great contributors. And they're variable. They go away, and you don't have to pay them forever. I don't want to be crude, but that's part of it. So I think one of the things we need to do is, it's great to teach entrepreneurism, but you've got to get those students sitting next to the entrepreneurs like this guy and see what it's really like a day to day to fight what's going on. That's what we need to do more of with students.
And I'll follow up on that real quick too. A real life example of that, and we've collaborated on a business. Tom Licks of Cleveland Whiskey is a byproduct of the Glide Fund, and also a byproduct of Magnet and Jumpstart and Cuyahoga Community College, and we're an investor in his company as well too. And a lot of his employees came from the students, and so I think 3 of his employees at this point came from students. And it's a great success story for the region. You know, it's built here. It was built here right in town with a lot of help and capital from everybody in this region. And shameless plug, they're launching their first product today. And
that's
so
exciting. Well, I think that's great.
Yeah, if anybody's a bourbon drinker, go to your,
and he's
not this early, later.
And he's a very dynamic entrepreneur. I just want to come back to this theme of openness and coffee houses, and let's get together and loosen things up and get together more frequently outside of the silos. I think that, one of the things that's striking to me, having worked and lived a number of years in the Bay Area and Connecticut and here, is, Cleveland's a wonderful place, comfortable place to raise a family. And I think that we maybe don't do as much socializing outside of our comfortable network and our families. OVA is certainly a structured organization, has an important role to play, as do all the institutions that we've got. But I think one of the things that I have not seen that much of is some of the successful entrepreneurs giving back time in informal ways, in informal settings. Very few and far between, and I know they're busy. The story is, well, you're too busy running your business, or I'm focused on making money. That's not the way it works in the Bay Area generally. It's not the way it works in Boulder. There's a sense of giving back, and whether it's done through a launch house or it's done through Bizdom or Charles Accelerator or Magnet, whatever it is, they're informal. You've got a beer in your hand, and you're giving back, and you're mentoring, and you're giving advice informally. So I think that that's something that we can quickly act on.
Well, and it's to the point that was made over here before. Putting these entrepreneurs together with mentors. And that doesn't mean you've had to run a tech business. If you've ever run any business, whether it's a manufacturing business or a chemical business, in that growth phase, you've had to fire somebody. That's a really tough thing to do, okay? It's not any easier for a tech guy. It's not any different for a tech guy. If you've ever grown a business, you face that awful day when you look at your CFO and you're like, how are we going to make payroll again? And you need to be able to explain that to a young entrepreneur, that's to be expected. We've all gone through it.
Right. All right, well, one more question. Okay, great, yep.
Oh, you've got everybody together. Why don't you ask them what would be a concrete suggestion for, you guys are onto something here. What's a concrete suggestion?
Oh, you want answers now.
OVA based or unlike that, whatever.
Right. Great idea. Yeah, great idea.
Collaborative, here's our concrete idea.
Yeah. Anybody have suggestions? Venues, frequency? Yes. Hey, Jeff.
I got together with two fellow business folks who are not entrepreneurs, but for dinner. Both in the tech or in the bio space. We knew each other, just as names and faces, and we just got together for dinner.
Right.
We just hung out. There was no, no agenda behind it. There was no,
Yeah.
open, had a conversation. And
That's great. So a lot of times, what's the place in Woodside everybody refers to as the
Bucks.
what is it?
Bucks?
No, the coffee house. Is Mark here? No. Well, there's Il Forneo or places in Palo Alto. There's certain restaurants. There's places where people will get together and eat meals, and you kind of see them, and they're informal assemblies like this. And I feel like we have to maybe create our own.
Right.
Right.
We were sitting down at dinner and said, this is pretty fun. We should get 2 or 3 more people just to do this next month.
Right.
But that's just it. It doesn't need to be an organized OVA event. I mean, I had a dinner at my house where I invited a bunch of local entrepreneurs and people in the venture business. And last night, Tim Mueller and the Cleveland Clinic got together with a bunch of entrepreneurs. And anybody can do it. Anybody can host a dinner or a breakfast or a coffee house just to get together and chat.
So maybe there's a way that we can, without putting a lot of structure around it, we have 12 months out of the year. Maybe we just get 12 folks that want to raise their hand now, or another time you can tweet it. And every month somebody takes responsibility. We'll do something at the casino or at the arena or at our office or at some restaurant. And somebody just takes the lead in organizing it and getting us together. Speed dating, yeah, that's an idea. That's certainly an idea. Okay. Thank you very much.